Greetings from outside of Nashville, Tennessee. Just flew here with a buddy of mine who's here, who is a bigwig in the real estate world. You're going to hear from him in a moment. And be sure to get your tickets for Empowered Investor Live, empoweredinvestorlive.com. Today, we're going to be talking about something that I talked about a lot during the Great Recession, and I was right. Yes, I'm going to pat myself on the back for that one again. It is regression to replacement cost, and it is how to virtually eliminate downside risk on real estate investments. And I can't help but feel with the the present construction labor shortage and the upcoming shortage of supplies due to tariffs. Now, a shortage is never really a shortage because as long as you're willing to pay enough money, you'll get your supplies, but that's going to push the prices of homes up very, very significant. So just remember all of that. Anyway, I want you to hear from my good buddy, Bill Allen, who is very versed in the real estate business. He started in real estate while he was in the military, in the Navy, and he's a test pilot too. That's pretty cool. Yeah. So, hey, just for a moment here, Bill, tell us what your current thoughts are on the market and what opportunities you see out there.
So for me, I always look at the inefficiencies in the market. I'm sure you talk about that a lot. Like, what are some things that we could do to have a competitive advantage?
Yeah.
And so for me, my business is primarily single family fix and flip and wholesale. And so what I see in the market is like operational efficiency is winning right now because there's not many deals on the market. And so what we're doing is going back to the basics, getting really good at having conversations with sellers, getting really good at follow-up, getting really good at showing up on time, doing the basic things.
And I would put management in there.
For sure.
Right?
For sure.
And
Operational management, but also leadership. So for me, like my job is to be the leader. I don't actually do a lot of the work, but I think in the real estate side, for us, flipping has become an area where we're leaning a lot more on.
Yeah.
So we're not wholesaling as many houses right now because we need to squeeze every bit of juice out of the orange now, where there's it takes me a while to find a deal. So.
And flipping margins have been compressed quite a bit. I mean,
true.
It's a lot harder than it used to be, right?
For sure.
Yeah.
But the contractors, they want jobs. They're some of the volume contractors that used to have a lot of work, they're not making as much money anymore.
Or you only have as much business. So
exactly.
They're not as impacted. So that part is easier, right?
Yeah. And so for us, it's really about figuring out for every single deal, how do we maximize the return? Because we don't have as much volume as we've had in the past. And so I'm trying to find the inefficiency. Another thing, like looking forward to hopefully some rate reductions here this year to really start buying inventory. Like we are buyers right now. I want to buy inventory.
And you said to me, we did a little fun interview on your plane on the way over as you were flying and I was your co-pilot. You were talking about how you're a buyer in every market. Tell us about that.
Yeah, if you stop buying, so a lot of people stopped buying during 2020, during COVID, they just stopped buying for 3 or 4 months.
Boy, did they ever miss out.
For sure.
Yeah.
And I was telling people throughout that time, you got to keep buying houses. Like I buy 2 or 3 big apartments a year. And last year we bought 2 big apartment buildings. We just are closing on another apartment building in 2 weeks.
Now, most people would say the apartment market totally oversaturated. It's a really dangerous, risky time to be buying apartments. Now, I think we're kind of bouncing around the bottom of that market, but a year ago, people would have said you're nuts.
Oh yeah, and 2 years ago, or last year, we bought 2 really big apartments. We bought about 600 units last year, about $45 million of apartments. When people are saying, oh, just wait. Like keep your money on the sidelines, keep your dry powder, just wait. I'm not waiting to buy. I'm buying now and I'm going to buy next year and I'm going to buy next year. But we just changed our strategy a little bit. I don't want any bridge debt. I've got 5-year commercial debt with a 30-year AM, fixed rate right now, 6.89%. So that's a good buy. And if I could find something that still fits in my profile, I'm going to buy it.
But a lot of people would sit there on the sidelines and say, I'm just going to wait till rates drop to 5% again or, whatever, right? And they try to time the market. I think the lesson that's sort of underneath what you said is that market timing doesn't work.
Oh,
and I talk about that all the time.
It doesn't work anywhere. You hear, man, you should have market, but the real estate's the same way. If I had my aunt call me, she's in Jacksonville Beach. She called me about a year ago and she said, Bill, I should have bought every house in Jacksonville Beach 10 years ago when I bought my house. And I said, you know what? In 10 years, you're going to call me and say, I should have bought every house today. And so just go buy as much as you can. So I'm always a buyer. I'm a buyer in every market. I always want a discount. I just always want to look for my competitive advantage. So find yours and be a buyer.
Good point. Good point. What is your thought about where the market's going the rest of the year? A lot of question marks right now.
Yeah.
I think that's a fair statement with tariffs and the labor shortages for construction and so forth. Just give us your thoughts real quick.
I think there's a housing shortage. I think that's obvious. Everybody knows that. And there's people that are in the market that want to buy. They just might not. The affordability is the problem right now. And there's not a lot of inventory. So where do I think it's going to go? I don't have a crystal ball. You're definitely a better market predictor than me. And I'm also in a short-term game. So what I look at is how do I get the discount today, and how do I get in and out as quickly as possible to each project? So I'm in and out of a project in 6 months or less usually. Apartments usually 5 to 7 years, but I think that it's going to be a strong real estate market. I don't see anywhere to go, but like moving up a bit until we really start getting affordable housing in check, getting more new construction buildings, getting more housing for people. There's just everybody wants to buy a house. I think it's going to be great to be a landlord this year. Yeah. I think rents are going to do really, really well. People need a place to live. So if you can find a good, affordable, clean place to live for people, your places will be full all the time.
Yeah, I think you're very right. The experts say the housing shortage is going to last for 7 more years before we can really cure the housing shortage in this country. So what other asset has those kinds of opportunities where you've got this built-in shortage, it's very inelastic, it's hard to create new housing, a lot of good things there. Want to give it a website or social media link?
Sevenfigureflipping.com. That's my company. And all my social media handles are at Bill Allen, REI.
That's Bill Allen. And let's get to our show today where we talk about regression to replacement cost and how to eliminate downside risk on a real estate investment. Be sure you got your tickets for Empowered Investor Live. We'll see you real soon. EmpoweredInvestorLive.com in Irvine, California. We look forward to seeing you there. And here is our talk on regression to replacement cost. When we're investing, as you know, my very unique risk evaluator model relies fairly extensively on construction cost and land cost as a way to determine how to minimize risk when investing in real estate. And it took me 19 years to discover that. And so far as I know, it is completely original thought. And my insurance broker at the time helped me discover that on one of my first nationwide property purchases. Before that, I had pretty much been confined to investing in California. And I did not realize there was a whole new, wonderful, beautiful world of investing out there and great opportunities. And I didn't have to rely on this speculative roller coaster of the California cycle to invest in properties. And it's been a great, great ride since then. So what I want to talk to you about today is different construction cost. And this was inspired by an article that just came out, and this is the NAHB, the National Association of Home Builders, and they, of course, discuss economics and housing policy. And they did an article, and it is about construction cost per square foot, what it costs to build properties in these various areas. And they look at contract price per square foot of new contractor-built single-family houses started in 2013. And this is very, very enlightening. And before I've talked about what I call, and this is one of my little trademark terms, trying to add to the language here of real estate investing, and it is called regression to replacement cost. Regression to replacement cost. And this example that I give you, actually 2 examples, has a lot to do with it. So we know that the riskiest markets are high land value markets because those are the markets that are cyclical in nature and they have big highs and big lows and really ugly lows, and people lose fortunes in those markets if they don't time it just right. And we also know, and I've talked about this on prior episodes as well, and that is that over time, the linear markets tend to do just as well as the cyclical markets, or even better in many cases. And I've given the example of Kansas City, Missouri, compared to Orange County, California. And you would think high-flying Orange County, my former hometown, would be the one that would win because they have such extreme upsides in the market. But over the course of 18 years, Kansas City actually outperformed Orange County in the example I gave, where Orange County average depreciation, and I'm just doing this from memory here, folks, but I think it was 5.2% on average, and Kansas City was 5.8% on average. And remember, the devastating things about these cyclical markets is that you give so much back when there's a downtime. And in these downtimes, which are very hard to predict, as you know, I have never met or known of anybody, any guru, any economist that can accurately predict appreciation and depreciation. And the prudent income property investor is the investor who invests based on cash flow. And if the appreciation comes, it is icing on the cake. It's wonderful when it happens, but let's not count on it. Let's just have that be a pleasant surprise. So when you look around the country, according to this National Association of Home Builders NAHB survey, you see that in the Pacific region, that includes California, Oregon, Washington, and Alaska, the average, or no, this is median prices, sorry. There is a difference between median and average statistically. And sometimes I prefer average to median, but again, that's a whole nother discussion for statisticians, and I could chime in on it, but I don't know if I can lead that discussion because I'm not an expert. Never took statistics class in college. I should have taken that one. I really would have liked to have been able to understand that stuff better. Anyway, the Pacific region, the median price per square foot is $145. In the mountain region, which includes, Nevada, Arizona, Colorado, and, all these states, right? In there, the four corner states, the median price per square foot of a single family home is $107 per square foot versus Pacific at $145. Now, occasionally, you can have actual cost of construction that makes this happen, but the thing you've mostly got here in these variance in prices is you've got a regulatory environment which makes it more difficult to build, so that will drive the price up, but also you have higher priced markets. And when you have a higher cost of living place where you're hiring people, hiring contractors and all these subcontractors to build a house, of course, you have to pay them more because they have to be able to afford to live in the place in which they work, right? And so that drives up prices a lot too. So the mountain region, $107 per square foot, Pacific, $145. The west north central region, it's called, which is kind of this area that would include Illinois and just kind of that area above Texas, okay? So that is $103 per square foot on the median price to build a single-family home. In the west-south central region, and that includes Texas and all the states around Texas, it's only, get this, folks, $85 per square foot, $85 per square foot. And then the east south central, which is just a little bit east of Texas, is $84 per square foot. Not much of a difference there. Those are both regions in which we like to invest. And then they pulled out another region here. They call it the South Atlantic region. So that'll include Florida, Georgia, the Carolinas, and that is $88 per square foot. And Mid-Atlantic, which is a little bit above that as we get close to the expensive areas, is $103 per square foot. And the New England states, way back up, just like the West Coast, the Pacific region, at $143 per square foot. Okay. And then you have the east north central region, which is near the Great Lakes, and that's $90 per square foot. Okay. So you see how these prices vary pretty significantly around the country. What does this mean to us? Well, before I get to that, I want to tell you that the median for the entire country, by the way, is $93 per square foot. And none of these numbers include land value. They all exclude the value of the improved lot on which the house is sitting. Now, what do they mean by improved lot? What they mean is a finished lot that is ready to build a house on. So it's graded, it's compacted, it has utilities pulled to the curb, and so a contractor can go and build a house there. It's ready to be built, okay? So $93 per square foot is the U.S. median price. Now, what does this mean to us? Well, it's pretty darn exciting. So I want to talk to you about a property that is available right now in Birmingham and compare it with some of these numbers, and you will find them to be rather interesting. Here I've got a great property in Birmingham. It is for sale right now. You can go to jasonhartman.com, click on properties, and you can find this exact property. And it is 1,104 square feet, and it's priced at $70,900. So that comes out to $64 per square foot that you see right on the Pro Forma. And now let's take the land value out of it. So I am going to just take a very rough guess here, not knowing what the land value is, and there are three ways that you would basically know the land value. One is the property tax assessor. It has their own opinion of land value. Of course, these opinions vary. Nobody exactly knows. So they're all an estimate, but they give you some idea. So the property tax assessor, they separate the improvement, the house sitting on the land or the apartment building sitting on the land, from the value of the land itself. That is one way you would have a clue as to the land value versus the improvement or the house sitting on the land. And it's very important to dissect this and look at both parts of the value driving equation. Another way is you would get an insurance quote. And the insurance company doesn't insure the land because the land won't burn down, but the house might burn down. And if the house burns down, they will have to pay to rebuild that house, or at least pay some portion after you haggle with them and possibly have to hire a lawyer to haggle with them or even sue them to pay the claim. You know how this can go sometimes. And that's why I always say the best insurance is a high loan balance. Let your lender haggle with them. Let them work with your insurance company to protect their collateral, okay? This property, I'm going to estimate the land value just as a very rough estimate at $25,000. And the three ways you can find that out, I didn't tell you the third. Here it is. It's an appraisal. An appraiser will make an attempt to dissect the land value versus the improvement value as well. So three sources that I'm aware of: the tax collector, tax assessor for property taxes, an insurance broker, an insurance company that's selling you a policy on the property, and an appraiser. So let's say, just for argument's sake, for discussion's sake, that this land is worth $25,000. So let's look at the land cost per square foot, not per square foot of the land, per square foot of the house, because I want you to see how much of this equation is potentially land cost, because we know we can purchase this property for $64 per square foot. But if you take $25,000 and divide it not by the square footage of the land, but by the square footage of the house sitting on the land, we're going to divide it by 1104, which is the square footage here. And that means our land value integrated with the house value is $22.64 per square foot. Now let's look at this. Let's take the purchase price of $70,900, subtract $25,000, leaving us with $45,900. So we took the price of both the land and the house. Let's subtract out the potential land value, and that's my estimate of $25,000. Let's look at $45,900 as the value of the structure or the house sitting on the land, the value of the improvement. Let's divide that by the square footage of 1104, and that means that the house cost is $41.58 per square foot. Well, I hope you're getting excited, because I am. Remember, I've talked on prior episodes about my trademark term, regression to replacement cost. And the beautiful thing is that you can still fetch a few properties out there. Again, these are drying up. There aren't that many. There is real urgency to be investing because prices have definitely been going up and they continue to go up, and business is very, very strong. So you're going to constantly see a lack of inventory, at least now. And so here you're at $41.58 per square foot is our potential for a calculation that we made. In this region, according to the National Association of Home Builders, it costs $85 per square foot to build a house. Now, this house isn't brand new, but it was renovated this year. So it's brand newly renovated. Okay. So of course, there is a difference between a new house and an old house. And some people really like older homes better. I mean, there are benefits of older homes. They just tend to have more generous spaces in a lot of ways. And I don't know, they just obviously have a very different style. Some like newer. It just depends. And, many people would argue that older homes are built better than newer homes. I don't know. I think older homes were maybe built with a little more care and quality, but newer homes are built with a little more technology. And so we could have that debate for a long time, but let's not bother. To rebuild this house, if it burnt down, an insurance company would probably spend about $85 per square foot, according to the National Association of Home Builders. Okay, and they have lots of members that build homes, so they should know. So if we take $85 per square foot, their number for construction, and we multiply it times the square footage of 1104, we can see that it would cost $93,840 to build this home today. Well, you can buy it for $70,900. So right there, you've got about $23,000 of potential gain already. Oh, you say, but wait a second, because we didn't include the land value. That's just the improvement. It's just the house. It's just the house sitting on the land. What about the cost of the land? Well, let's add back in $25,000, our potential lot value estimate. And then we add those two together, $93,840 to build the house, plus $25,000 for the land, and we get a grand total here of $118,840. So we'll just call it $119,000. That means when all of those construction materials are worth what they actually cost, and I know that's kind of a funny thing to say. It's like the concept of, and I've said it before, when a piece of wood is worth what a piece of wood costs again. I used to say that during the down market to illustrate my regression to replacement cost concept and my philosophy. When it regresses toward the actual replacement cost, you have a potential gain in this property, and this is not really the same thing as appreciation. Regression to replacement cost, I would argue that that's homeostasis. It's equilibrium. It's just what it should be worth intrinsically. You have a gain potentially here of $47,940. Now, that's pretty great, okay? That is pretty darn awesome. You can see examples. There aren't as many as there used to be, but if you go to jasonhartman.com and you click on properties and you start browsing through all of the property pro formas, you will see several examples, not as many as you used to because prices have gone up and they continue to rise. You will see examples of some lucky deals that you can still get where properties are priced below replacement cost. This is a good example of that. And just like this property that I just told you about, where you are buying below the cost of construction, you've got regression to replacement cost opportunity built into the equation. One of the things I do is I will not allow our local market specialist to represent their properties as being below market value. Even though, in my opinion, many of them are below market value. I will not allow them to represent the properties that way. So when you look on the pro formas that you see at jasonhartman.com, you'll see one number for initial market value and another number for purchase price, and those numbers should always be the same unless they snuck one by us and we didn't catch it. But those should always be the same. But when you understand the math of the two components of an income property investment, the land component and the improvement or the structure sitting on the land component, the house or the apartment building, or, if it were a commercial property, it could be an office building or an industrial building or a retail building, whatever. The point is there are two value drivers in any real estate equation. One is the land, The other is the improvement sitting on the land. And you've really got to dissect those and understand them. One reason also is because you only depreciate the improvement on your tax return, not the land. The land will always be there. So the IRS does not allow you to have this awesome depreciation opportunity. And I should mention, for those of you who are the gamblers and the speculators out there who like to invest in expensive markets, I'll call them overpriced markets, whether they be California, the New England states, as we just saw, or whatever, if they're Miami, these expensive markets. Remember, you don't get nearly as much tax benefit in those markets because your land cost is so high and your improvement cost is so low as a ratio to land cost. And you only get to depreciate the improvement cost. The example I give when I talk about the risk evaluator and how to really, really reduce risk, if you want to hear more about this, just go to jasonhartman.com and there's a little search bar on the website. Just go ahead and search the Hartman Risk Evaluator, okay? And you'll find prior podcasts where I've talked about that extensively and some blog posts and so forth that explain it. And, you really increase your risk when you invest in high land value markets, but you also massively decrease your tax benefits and, of course, your cash flow. And, of course, we are prudent cash flow investors. We're not the gamblers. We're not the speculators. We're on the conservative side. So in this property that I've been talking about with you, I'll just tell you a few more things about it before we get to our guest. The projected return on investment overall on this property is 38% annually. 38% annually. Cash on cash return projection, 15%, and cap rate or capitalization rate of 9.7%. And get this, your debt coverage ratio with 25% down is 2. That means your property could go badly half the time and you'll still cover your debt service on this property because you've got a debt coverage ratio of 2.00. A lot of our properties, they have debt coverage ratios of 1.4, 1.6, 1.8, something like that. I've actually been looking for one for you that is a 2, and this is a 2. So what a champ. I mean, this property has a projected cash flow of a little over $3,400 annually. So, and that's with your maintenance, your property management, your vacancy, all imputed into that equation. So make sure you really know how to analyze these deals, folks. And another thing I just want to recommend is the podcast and the YouTube video that shows the visual, and you can follow along on how to read a property pro forma. Just look for that, and it is a fantastic tool. It will make you a better investor, and it's just a great lesson on how to read that. But it doesn't talk really much at all about this land to improvement value equation that I just shared with you. So this is for advanced investors who really are thinking about all the multidimensional aspects of their income property investments. And I know that's you because you listen to the show and you want to know more and you want to be a more prudent, more sophisticated investor. So thank you for doing that, and thank you for doing your homework and really studying this stuff. And please do, if you like the show or even if you hate the show, we had a few reviews come in last week and I really appreciate that. I know I never ask, but it really helps us get the word out there about the show. So write a review. You can do it in just 3 minutes or less.